In a good gold market, in a $2,400 gold market, and in case any question, we're in a good gold market, right? Like there's no disputing, despite the fact that you have, ETFs until recently, you've still been selling gold into a good gold market. We've got a good gold market.
Yeah. Historic moves in the gold price, but the junior mining sector has yet to catch up. Is this presenting us with an opportunity to participate in a significant capital appreciation as we move into the coming quarters and years? Today, we're pleased to be joined by Dan Wilton. He's the CEO of First Mining Gold. He's going to share with us his thoughts on what's going on in the general gold market and specifically with his company. Dan, welcome to Ron's Basement.
Ron, always a pleasure to be back in the basement.
Well, we were talking before we came on how we're both kind of perplexed with what's going on right now in this sector. We've got this historic high gold price, and I think it's safe to say historic value propositions being offered by all of the junior mining stocks. Do you have any thoughts on what might be going on out there?
Lots of speculation. We've seen these cyclical moves before, right? Those of us who've been around the cycle for a while know that that pace of catch up comes in waves. And I think, we're seeing it in the large cap golds now. You're finally starting to see gold equities that are getting a little bit of a bid here on the back of the rise in the gold price. Not nearly as much as you would expect. I think you just have to go back to 2020 and recognize that was in the run up to a much lower gold price.
Right.
And you had equities, even large cap equities that were multiples of where they are now still. I think we're just this catch up game takes time for the trickle down to come. It hasn't really hit in the producers yet, but it will. It will. Mm-hmm. And we're going to see that over the next couple of quarters. Some of these larger cap stocks are up 30 to 50%. And at some point, investors start allocating to the sector as they chase performance. And when that happens, eventually you get, the trickle down effect to the poor developers like us, where people are looking for value. And so that's the interesting opportunity we see right now, Ron, is that opportunity to kind of front run that trade. Everyone knows that it's coming. It has to. It has to for a lot of very fundamental reasons, including the fact that the industry just has not made investments in productive capacity over the last 12 years.
Yeah. I'm going to pull up this chart, Dan, from your investor presentation that shows the performance of gold since, what is that, January of 2020?
January 22.
Yeah. And when we look at the GDX, the big gold miners and the GDXJ, the junior producing gold mining companies, they've kind of sort of kept pace with the gold price increase. But when you look at the junior, the development sector, the black line, it's so far behind. And we were talking before we came online. I asked you the question. I said, isn't this all supposed to be inverted in a historic perspective? Like the miners typically actually outperform gold, and the development companies in a healthy market will even outperform the senior companies.
Yeah, I think that all just speaks to the fact, Ron, that we're in early stages of this rally, very early stages. You've seen some of those. What I find really interesting in that chart is just in the last, half inch of the line, where you actually see, even in the last few weeks, you've had gold producers really start to tick up, and you've had gold developers tick down pretty substantially. So, that gap is widening up. And in every other time in my career where I've seen this gap widen out, it gets closed by the M&A market eventually. Yeah. Eventually, larger companies, who can go through periods where they forget that they're in an extractive industry. And if they don't replace their reserves, at some point they get into massive reserve decline. That we're coming to a point where those lack of investments that have been made in reserve replacement over the years are going to start to make it more and more difficult for them to either find or, ultimately add to their existing asset bases. Yeah. So at some point they're going to have to come and buy new projects to develop, and no one's wanted to do that in an inflationary environment. I think we're, knock on wood, feeling pretty good about the fact that I think we're through the worst of what we saw as inflation in the mining sector in terms of, input cost inflation, labor cost inflation, capital cost escalation. I think we feels like we've seen the worst of that now. You're seeing it in the results in the gold producers. So that to me says, again, we're coming to the time where larger companies are going to have to replace their reserves and resources. And when you look at the amazing value that a lot of these developers trading at, it's pretty compelling right now.
Yeah, I like to call that gap that we see on this chart between the developers and the gold price, and even that area above it. That's the opportunity gap. That's the opportunity.
You have to brand that, Ron. That's brilliant. I've not heard that before.
Or the capital appreciation opportunity gap. You talked about the big producers and needing to replace their resources. I want to go to the next slide here, and I just find this astounding. I know that your company, First Mining Gold, has two of the largest development stage projects in Canada. But when I look at this graph, which shows us the amount of gold that's been discovered in just some of the more recent years, if I just go back 10 years to 2014, it looks like there's almost been no gold discovered. Dan, any comments on that?
Well, I think that's the reality of it, Ron. Honestly, the funny part about this graph is it mirrors almost my career in terms of when I started working in and around the mining sector. Is at the very left-hand part of this graph. And there were a lot of big discoveries at the times, like major world-class mines. The reality is those discoveries are coming fewer and further between. And this is, we came across this chart of data that was aggregated by S&P. It's extensive research that shows they're actually spending a lot more money now, even, versus historically, spending a lot more money on exploration. It's just more difficult to find things. And the reality is all of the easy stuff to be found, by and large, has been found. That's just the exploration business. You first find what's on surface, and then, you start going after deeper, more difficult deposits in more difficult jurisdictions, more difficult terrain. It's a bit of a logical consequence that, for you to find more, I think you're going to have to see exponential exploration spend on what's there. But it's continued to provide this big gap in terms of ongoing annual production and, how are those reserves being replaced? Now, there's always games that producers can play for a short period of time. And we've seen it happening over the last couple of years where they drop their cutoff grade for resources. They increase their gold price for calculating resources and reserves. It brings more in around their existing deposits. And fair enough, you're in a higher gold price environment. But that game has a limit as well.
Yeah.
These companies are going to need to add, millions and tens of millions of ounces in order to, ultimately give themselves the productive runway, going forward. And we're starting to see some of these big mines that were built in the last decade, are actually coming toward the end of their mine lives. Yeah. So that reserve replacement is becoming more and more important.
Yeah, I think visually when I look at this chart, I mean, from left to right, I mean, back in 1990, even the mid 90s, we were having years where over 200 million ounces of gold were being discovered. And again, when I go to 2014 to present, it looks like, maybe 20, 25 million, 5 million, 10 million ounces of gold per year. And when you look at the amount of money being spent, the black line, the budget, they're spending more money, but obviously not finding as much gold. And that could be an opportunity where a company like First Mining, who has two huge projects in Canada, could be there to fill the bill. But the market has yet to recognize that, right? The valuations have yet to catch up. And it could be an opportunity, like nobody has a crystal ball and we're not giving financial advice, but it sure feels like a compelling value proposition, when you run the numbers on a company like First Mining and look at, the total number of ounces of gold that are in the ground, safe in Canada, that have already been discovered, right? There's decades of work that have gone into drilling and establishing those resources. And I want to point that out to our viewers. Well, First Mining, Dan's company, and Dan, of course, can correct me if I'm wrong, but you're a development stage company. The gold is already there. Like I just previously said, the money's already been spent. The work has been done. Now it's the process of working through the permitting process. And can you give us an update? Obviously, the two flagship projects, Spring Pole in Ontario, Du Parquet in Quebec. Actually, you had just some recent news come out about Du Parquet. What's the latest on the Quebec projects?
Yeah, so we'll start at Du Parquet. Put out some new exploration results yesterday, I think.
Yep. Mm-hmm.
That I demonstrate what we've been saying all along, which is that, we have a huge resource endowment there. It's 3.5 million ounces of measured and indicated, another 2.5 million ounces of inferred, located in the middle of the most sought after gold district on the planet. So that alone is not really recognized. And I think when you understand what's gone into developing those resources, 270,000 meters of drilling, just the replacement cost of the work that's gone into it is easily $100 million. So, I think there's phenomenal value there. But what we've been saying all along is that it's just scratching the surface, right? There are hardly any drill holes below 600 meters in the Du Parquet deposit. They mined 500 meters down in the 1940s and 1950s. And so that to us gives, real line of sight that we're very confident this deposit continues at depth. Just about every drill hole that's drilled at depth encounters more mineralization. But the important part here is that you have to be able to find higher grade gold the deeper you go. And that's part of what is really important about these drill results that we put out yesterday, is that James Maxwell and Caroline Pienaar and our exploration team have been able to identify, very systematically through about a year's worth of compilation work, identify key priority structures they thought held higher grade gold. And sure enough, we're drilling what are some very interesting intercepts, certainly some in the open pit that aren't that deep, 10 meters of 3 grams plus, and then being able to follow those higher grade areas of mineralization to depth. And that's where in the Abitibi, it's not at all uncommon that you see those higher grade zones get wider and higher grade as you go to depth. So, it's a really, I think, interesting demonstration of what we've been saying all along. We think this deposit, starting where it is today, is a phenomenal endowment, but we're just scratching the surface. And this is a place you're going to be mining for a long, long time.
And as you're going deeper, the idea would be, like you said, that you would find higher grade deposits down there. Would that mean the potential for going underground with mining eventually?
Yeah, and even in our PEA, we outlined really a big bulk tonnage underground deposit, really extending kind of the mineralization from the bottom of the pits or just below the bottom of what we saw as the economic open pits. We know that there's economic mineralization at depth. The trick is, again, finding the areas of higher grade, those areas of structural control that, you can tag into something that is going to be more economic to help drive the infrastructure to depth. Now, we don't particularly need to worry about that given the size of the deposit and where it is. This might be, an opportunity for a number of years from now, but strategically, it's really important because that's where you just have to kind of follow the story of what's happened at the Canadian Malartic project, which Agnico now owns 100% of. They had an open pit, not too dissimilar to what we have at Du Parquet, turned it into the biggest gold mine in Quebec. And now they're in the next phase where they're going to be underground mining massive wide stopes at around 2 grams per ton, which, is certainly what we were looking at in our PEA. But these big stopes they're going to be producing 20,000 tons a day from underground. So, and they're going 1.8 kilometers down. right? We're only still talking 500 meters. So it opens up all of everywhere in between those levels for exploration potential. And that's what I think strategically can get some of the bigger mining companies really excited. Are we really into something here that's going to be 15, 20 million ounces plus? And we think there's every bit of possibility for that at Duparquet.
Yeah. And based upon that graph that we looked at earlier that showed just how few and far between new discoveries are within the gold mining sector, I would think that the big companies will want to get excited. I think another thing that they'll get excited about, not just with the Duparquet project in Quebec, but also Springpole in Ontario, is the location and that it's in, you know, a very safe jurisdiction. There have been years and years of work already put in to kind of work these projects to where they are within the both development and permitting process. And that's going to be real appealing to the big companies, especially in a world that's becoming, you know, geopolitically a little more, let's just say, troubling for all of us.
I would wholeheartedly agree with that. I think there's never been a time in the mining industry where location has mattered more than it does now.
Yeah.
You know, rule of law. There's a lot of jurisdictions that for a long time were considered absolute tier one that have become more and more challenging over time. So, you know, one place that I think everyone can agree is a great place to own a mine. Well, two places, Ontario and Quebec. You know, and you've
flip a coin, right?
Yeah, I know exactly. Well, why choose? We have both. You know, that's it's phenomenally underappreciated right now. But I think it's just one of those boxes that someone who's going to look to replace their reserves, you know, a couple of years from now, looking for projects that can be built. Because for all that we were looking at discoveries there, that's resource definition, right? In that last chart. What you need to understand is not every 5 million ounce deposit plus is going to become a mine.
Yeah.
A lot of them have real challenges. You still have to understand the economics of those big projects. And that's where, you know, from the point of, okay, great, we have a resource, from that point to producing gold on average in Canada, in the gold industry, well, from discovery to production is now, I think, an average of about 17 years.
If you're looking to buy gold, silver, or platinum, do yourself a favor and check out Pembex, the online precious metals bullion dealer and sponsor of Ron's Basement. I was a happy customer before they offered to support the channel. You'll find they have the best prices, quality, and service. I think Pembex is best, and you will too. And be sure to tell them that you're from Ron's Basement. Is it fair to say that the Duparquet project, and I'll throw Springpole, that they're advanced development stage? I mean, because like you said, it takes years and years to get, you know, once you discover a deposit, then it takes so many years to go through the permitting process. And I think part of that is maybe what makes Canada, you know, a premium location, but First Mining has already done a lot of that legwork, right? You're not at the finish line yet per se, but you are, you know, 50%, 75% along that path. And again, you know, you're a premium location within a premium location.
Yeah, so we kind of frame it as getting to the starting line, not the finish line, because
Okay.
you know, you get your environmental assessment approvals, and then it lets you start to do some more interesting things in terms of getting your project ready for production, but or construction at that point. At Springpole, sorry, you know, we entered the environmental assessment process federally and provincially in 2018.
Yeah.
So we're 6.5 years into this process already. And while maybe there are a couple of those years, you know, during COVID, maybe a couple of years where it wasn't as resourced as well as it needed to be, there's no real shortcuts to this. So while we always say, you know, it's important, the only thing worse than being where we are is being anywhere before where we are in a permitting process, right? Because you're going to have to go through it. It's going to take some time. And there really are no shortcuts on time or quality of the work that you're doing. So lots of work that has been done, lots of work we will obviously continue to do. But at Springpole, we are submitting our final environmental assessment document in September, and targeting, final environmental assessment approval at the end of 2025. It's a major, major milestone and catalyst. Because I think if you go back and look at the history and the value at which bigger companies came into large development projects in Canada pre-construction, we've got a slide in our investor deck that talks to it, but there are a number of those, if not most of those, are financed or acquired at values of $500 million to $1.1 billion over the last few years. So pre-construction, before a shovel's gone in the ground, that's the value of having those resources and having the permits to move it forward. So is there value in us going through this process? Absolutely. We've always said, when Keith set the company up in 2015, they were buying great resources at $10 an ounce or less. But the real home run is getting these resources to a point where someone else will come and acquire them for $100 to $200 an ounce. Mm-hmm. That's usually what happens after you get kind of through the permitting process and where we're kind of making great progress in going. And you get a little bit of competitive tension at a time where you have an escalating gold price. And wonderful things can happen. So lots of hard work in front of us yet, but when those milestones are 18 or 20 months away versus, where it was 5.5 years ago when I started as a CEO, every now and then you got to take a step back and recognize just how far we've come, just how much real work we've done to advance these projects.
Yeah, and there's a number of internal catalysts. There's a number of external catalysts. I mean, that chart that we looked at the very beginning, if that goes back to more historic norms and mining stocks actually outperform and provide leverage to the gold price, and the development companies even more leverage, there's just a lot of things that could happen. One thing that we don't consider is, Citibank, for instance, is predicting that we could get to $3,000 gold next year. I mean, things can change the complexion. I think a lot of people, when it comes to First Mining Gold or any of the other development companies, think, well, I'll wait. It may be too late at some point. Things will happen. The market will anticipate. And suddenly, people could find themselves in a situation where they potentially missed the boat.
I think that's exactly right. And the way that I think about it is, this is your opportunity to get the first 1 or 2x on what could be a 10x return, right?
Right.
And if you miss out on the first 2 or 3x, then you're into a 3 to 5x return, which is not bad, right? That's right. But that's where most investors will end up by. You never try and time the bottom. Timing the bottom is a mug's game. But being invested while you see these massive disconnects in fundamental value, that's the real opportunity for the value investor who's looking at the sector right now. Because, Ron, as far as I'm concerned, it is an inevitability that larger producing companies are going to have to replace their reserves. Mm-hmm. That is a truism. It has to happen, right? Or they go out of business. Right. And it's never been cheaper for them to replace those reserves. There's never been less risk in them replacing those reserves by buying a developer than there is right now when you look at the difference in valuation between where producers are trading and where developers are trading. So, they've all been afraid of CapEx for a long time. They've not wanted to go through permitting processes. All of those are major catalysts that we can de-risk this project in the next couple of years. So I think very, very bright days ahead.
Yeah. And I'm going to pull up another chart here just to put things in context. This shows the Duparquet and Springpole project and just how few projects there are of that scale in Canada. Any comments on this, Dan?
Yeah, listen, I think there's a couple of important takeaways on this chart. Number one, you have to look at all the ones that are in construction right here. Right? What a lot of people don't appreciate is that we've had, for all we say, the industry hasn't been investing. The few places they have been investing, one of them is Canada. And you've seen a number of these big projects attract billions of dollars of capital to get built. And that, to me, in what has been, as we just showed, a really challenging time for gold equities and for companies to raise money. So when you talk about what are the most strategic assets in the gold industry, I think big projects in Canada unquestionably have demonstrated themselves to be the most strategic assets. They will get acquired by, gold producers at some point. I have a much higher percentage here than I think you do anywhere else, maybe Australia, but even than the US, just because there are more opportunities here than there are in the US. But what's really interesting, Ron, if you have the other deck that's up here, you look at the next slide and what this opportunity set looks like when you take out the ones that are in construction, because most of those ones in construction are actually going to be producing gold by the end of this year.
Mm-hmm.
And then that opportunity set looks very small. We've got 2 of the top 10. And I think importantly, one of the next projects to get environmental assessment approval. And, speaking realistically about it, one of very few projects, maybe 2, depending on what we do with Duparquet, but maybe 2 of the projects that could potentially be put into production before 2030. Because if you're not well advanced in that federal and provincial permitting process right now, you're not going to get there in order to make a construction decision to build a mine before 2030. There's actually come from a period of magnificent abundance of development projects in Canada, like 7 ready to build at one time. We're coming to a point of maximum scarcity of projects to build, which is a great place to be if you're the one who owns projects.
Right. That are already, there's no, when you go to an amusement park and you can pay extra to get a skip the line pass, there are no skip the line passes for permitting gold mines in Canada. Or are there, Dan?
No skip the line passes. For big projects, generally you have to go through a combined federal and provincial process at some point. Where there are opportunities, and we've seen, a number of other companies do this, is looking at that staged development opportunity. We don't have that as much at Springpole as we think we might at Duparquet, which is an ability to start smaller and potentially grow, start with a smaller capital project and grow a resource over time. Not the resource, but, kind of grow your production over time, because we're so not resource limited at Duparquet. We have such an extensive resource there. Even our PEA that we put out only produced less than half of the ounces that we have at the project right now. So lots more work to see how we continue to develop those other ounces.
Yeah, very interesting. And as I was talking about the skip the line pass, if you're a big gold producer and you want to get a skip the line pass, you can get it from First Mining Gold, but you will be paying a big premium, right? Because you've been waiting patiently, working your way, doing your work through this permitting process for a number of years. And I think that goes back to what you said earlier. Let me pull up this slide, Dan, because we don't talk enough about the other projects in the portfolio. And I think they're important. You've got the Pickle Crow project, the Hope Brook project, and Cameron as well. Can you, what do you think when you look at that portfolio of those 3 projects?
I think you've said many times before, we don't really get much value for these other projects. And the reality is, when you look at them on their own merits, I mean, we love these projects. We know them very well because we used to own 100% of them and still do at Cameron. Yeah. So, I think while we often really focus in on the scarcity of 5 million ounce plus gold projects, the same really can be said for million ounce gold projects. There just aren't really that many million ounce resources in Canada that can be moved forward. Our partners are doing a good job. I think what's important is just the amount of money that our partners have spent on these projects and advancing them, growing them. I mean, I'm looking at the resource profile there with Pickle Crow. I think that's really only our 30%. That's an out-of-date number there for sure. The resource number at Pickle Crow is now, I think, almost 3 million ounces. Wow. Our friends at Firefly, formerly at Teco, have spent tens of millions of dollars drilling there over the course of the last 2 or 3 years. So, they've now pivoted onto a copper project, which they're having great success with. But I think the reality is Pickle Crow still sits as one of the largest, best defined, high grade underground deposits in Canada. And one of the largest in the world. Like 3 million ounce underground deposits are pretty rare.
Wow.
So I think they're doing great work there. We'd love to see a little bit more going, but our position there and our position in Big Ridge or in Hope Brook as well. When we negotiated our partners coming into those deals, we negotiated carried interest for ourselves. So while our partners spend money on the projects, our project interest doesn't dilute until, at Hope Brook, until they produce a feasibility study, and at Pickle Crow until they make a decision to mine, which is basically a construction decision. So, great opportunities there. We show in our investor presentation that those projects have, value in the sort of $20-ish million range. And that's just based on the share prices or the value actually of Firefly before they bought the project in Newfoundland. But in a good gold market, in a $2,400 gold market, and in case any question, we're in a good gold market, right? Like there's no disputing, despite the fact that you have, ETFs until recently have still been selling gold into a good gold market. We've got a good gold market.
Yeah.
And these projects will have immense value when we're able to tell the story about how our partners are going to unlock that value too. So, could that be multiples of what we hold on the value? For sure. Yeah. There's lots going on those projects. And again, just adds more leverage to an increasing gold price environment in First Mining stock.
Yeah, a more sane and realistic valuation environment within the entire gold mining sector, and so many factors that are pointing toward. I like to use the word a confluence of factors that could come together, help First Mining Gold, help the whole sector get back to what I would say is more realistic valuation levels. If people want to learn more about the company, they can go to firstmininggold.com. If they want to talk to a real live human, we have a gentleman you can reach out to, Paul Morris, the Director of Investor Relations. Would you recommend people reach out to Paul, Dan?
Absolutely. Paul is a wealth of information and can certainly guide you to any other information you might be looking for as an investor. So great resource.
Yeah. Well, thank you, Dan. On behalf of myself and the viewer, we've learned a lot today. It's going to be interesting to watch the gold market, the development market, and in particular for me, since I'm a shareholder, First Mining Gold as well. Thank you, and we'll look forward to seeing you next time.
Thanks, Ron. Always a pleasure to be back, and thanks for all that you do in terms of building and continuing to grow this community of those of us who focus on precious metals. Really appreciate it.
You're welcome. Thanks, Dan.